The traditional link between the US Treasury yields and the dollar has broken down, with higher yields now coinciding with a weaker dollar. This shift is driven by investor concerns about the US fiscal discipline and policy uncertainty. Historically, rising yields signaled confidence in the US economy, boosting the dollar as a safe haven. Now, policy volatility and the growing credit risks have disrupted that pattern, forcing the investors to rethink the hedging strategies and driving interest in alternatives like euro, yen, Swiss franc, and the gold. Hello everyone, welcome back to our channel and welcome back to this video. In this video, we wanted to share with you how the correlation is breaking between the dollar and the treasury yields, and hence we wanted to share with you when correlations break, the dollar's divergence from treasury yields and how it exposes deeper risks. For years, the US dollar and the treasury yields have moved in tandem, a relationship that has served as a key barometer for investors worldwide. Higher treasury yields have traditionally signaled confidence in the US economy's strength, attracting foreign capital and bolstering the dollar's value. But that relationship is now fracturing, revealing cracks in the foundations of America's financial markets. Recently, we have seen the treasury yield climbing from 4.16% to 5.42%, a move that would typically coincide with a stronger dollar. Instead, the dollar has dropped by 4.7% against a basket of currencies. According to Goldman Sachs, the correlation between the yields and the dollar has fallen to its lowest level in almost 3 years. Let's try and understand this disconnect. Under normal circumstances, rising yields would indicate a stronger US economy and attract inflows into the US assets, pushing the dollar higher. This time, however, the story is different. The yields are going up because US debt is more risky and due to the fiscal concerns and the policy uncertainty, and at the same time, the dollar is weakening. This dynamic is more commonly associated with emerging markets, and it has investors questioning the very foundations of US financial stability. The recent Moody's downgrade of the US credit rating has further highlighted concerns over the fiscal sustainability. Analysts show that the US credit default swap spread, essentially the market's price for insurance against a US government default, are now at levels comparable to those of Greece and Italy.